Okay, we're getting started. So we have several viewers in YouTube and some on the Hangouts application and also Hangouts on desktop. And several people who cannot join today will also see us on the recording, which I will publish in my YouTube channel as well as in the website taldavidson.com. So I'm very happy to have reached this moment. This is a launch celebration. I'm a little bit excited. I guess that you can see that. I've been working years to get to this place, to this moment, and it's a very exciting moment for me. This endeavor of starting a website and deciding to spend my time helping individual investors like myself grow both intellectually and financially is something that I started, I think, 3, 4, 5 years ago. So I had several iterations of that. I had a website which resembled a little bit what Seeking Alpha is doing today and doing much better than what I did back in the day. Then I have a website around gurus. And finally, once I transformed to be a quant investor, I started the current iteration of taldavidson.com. So first and foremost, let's start with a toast. So I have white wine here. It's an Israeli white wine called from the Gewurztraminer. So it's from an Israeli winery called Tavor. So I will be celebrating with a glass of white wine, and I would like to raise a toast to the community. The community, and I hope that the community will grow and will help each other and support each other through the investing and through tough times in the market and good times in the markets, and let us grow both intellectually and financially and help each other and to riches and intellectual riches and success. So I'm raising this toast. Cheers and amen. So I want to start with saying a couple of things in the beginning of this live event. I believe that individual investors have great advantages over institutional investors. And basically what I believe, and I'm not the only one saying that, individual investors can make better returns than institutional investors. Now that may seem to be counterintuitive. I mean, how can individuals like us who have day jobs or have families, who spend just a little bit of our time investing, can compete with professional? It sounds really counterintuitive. But actually, that is what Benjamin Graham has been saying for a lot of time, and even Warren Buffett. You do not need to be a genius to do well in the market. You need the right temperament. And if you have the right temperament, as an individual investor, you can do better than institutional investors. So, but there are specific reasons why individual investors can do better than institutional ones or professional investors. One, individual investors are not pressured to show yearly returns. They can develop a longer-term view. I mean, if you look at the professional investing market or the professional advice market, professional investors, they have to chase monthly returns and yearly returns. The first question that you will ask a professional investor is, what were your returns last year? What are your returns year to date? And actually, it's not a good question to ask, but that's how the industry works, because the investing cycles do not follow a calendar year. So sometimes you have to be invested for several years to beat the market. And you cannot beat the market year by year. And if you try to chase yearly returns, then eventually you will lose. That's the funny thing, because then you will try to chase short-term gains and those are elusive. Okay, you cannot find short-term gains with consistency, while you give up the really cheap stocks or the really good opportunities that will bear fruit in the long term. So individual investors are not bounded to show yearly returns or monthly returns. They can develop a longer term view and really benefit from that, because they will beat the market and beat professional investing over the long term, even if on the shorter term, on an year-to-year basis, sometimes they don't perform as well. So hold on. The second thing where individual investors can do better than institutional ones is individual investors can go small cap. So I guess that all of us, we know that small cap has better potential to do better than large cap. Large cap is a crowded space. Everybody goes there. The stocks get so much attention, so much press, that the opportunities become not opportunities. They lose their alpha. Because basically the price is more, the price is right, so the opportunity is not existent in large cap in most cases. Now there are exceptions, but in most cases. Individual investors can invest in market caps of, let's say, $100 million, $50 million. They can even go down to, I go even down in my personal account to $30 million market cap. And that's where the real opportunities are at. I mean, if you look at small caps, they get very low coverage. Even at Seeking Alpha, where everybody writes about every stocks, you get really low coverage for small caps. So you can find hidden gems, you can find great opportunities with small caps. You have to apply some judgment. It's not that all small caps will do better than large cap. Many small caps are just junk that you wouldn't touch, or very, very risky stocks that you wouldn't invest in. But if you know what you do, let's say if you use the screeners that I have on the website, then you can find compelling small caps, and those small caps have a greater chance to rise and become bigger and do better. And so that's small caps. And the reason that institutional investors cannot invest in small caps is because they have limitations. Sometimes, or most of the times, the funds are too big, so small caps really don't move the needle. They don't make any difference. So why spend the time and effort to research and analyze small caps while they need big stocks to move the needle? And so that's the institutional constraints that professional investors have, and that's the advantage that we have as individual investors. The third aspect of why individual investors can fare better than institutional ones is that we can avoid institutional biases. We have no career risk. I mean, many professional investors, they work in firms, so there's a consensus around certain stocks. Like many analysts thinks that Apple is still undervalued, so everyone buys Apple. So you wouldn't want to be caught not buying Apple, because then your clients will ask, hey, all these professionals, Warren Buffett and all, they're buying Apple. Why don't you buy Apple stocks? So they fall to biases. They want to look good to their management. They want to look good to their peers. They have cognitive biases. They have career risk. It's better to fail together than bet on something where you're a contrarian. You're the only person who's taking this bet. So many people just invest in what their peers invest in, because they say, if we succeed, good, and if we do not succeed, then at least everyone took the same bad bets. So that's why individual investors can do better. And really, the website, taldavidson.com, is all about helping individual investors beat the market and grow financially and intellectually. So the second thing that I want to cover is, why did I create the website, taldavidson.com? Let's discuss the struggles that I had. So my biggest struggle, what was my biggest struggle? It was not having time. Time is the most expensive asset we have. It's the scarcest asset, even more than money. A long time, us, as we grow older, we earn, we save money, we invest money, we get money, but our time is running out. So time is the most important asset. And really, I didn't have any time. So I love the stock market, and I think I've written it in my emails. I love the stock market. I'm passionate about the stock market. I love researching stocks, but I didn't have time. I didn't have enough time to move the needle, to make it significant. So I thought, how can I do it? How can I beat the market? How can I invest intelligently with a full day job, with a very demanding day job at high tech, which I'm still working at, and a family with 3 young kids? And the answer was go quantitative, use models, use algorithms, use the computer to save time. And this is what I'm doing. And I think my main influence in doing the transition from being a discretionary investor, where I research every stock that I find compelling, to being 100% quantitative investor, was Yoav Zelikovich, my friend. I write about him in my letters, in my emails. And also I'm going to share an interview that I'm going to conduct with him later this week. Yoav is a rising star hedge fund manager in Israel, and one of the, I think, the most professional money manager in Israel. He's doing an excellent job, and he's not the typical kind of money manager. I mean, he spends hours every day reading and learning. How many money managers spend their hours every day just reading and learning and becoming better investors? So this is Yoav, and he was my main influence of doing the transition from being a discretionary investor to a quantitative investor. So time is a big struggle, and creating those algorithms, creating those screeners that I now share in taldavidson.com, managed to save me a lot of time to do several things. One is to search for competing investment ideas. So now that I have my algorithms, now I find them very quickly. It's right there. Okay, the algorithms, they prune hundreds of SEC filings. They do the heavy lifting. They provide me the investment ideas. And also, I'm investing quantitatively. So I'm building the portfolios out of those algorithms with the stocks that the algorithms find. And so I don't spend time on that. And I'm a long-term investor, so I rebalance my portfolio only every 6 months for the momentum portion of my portfolios, and every 1 year for the value portion of the portfolio. So really, I spent months and years building those algorithms, but now they save me a lot of time. So this was my first struggle that led me to build and code the algorithms behind taldavidson.com. The second thing that I struggled with is mental support. I mean, developing the right temperament and being able to maintain it. I lived through the 2008 and 2009 crash. So it was those were very hard days. It was a very scary time to live in and be invested in, and I was fully invested. And I found that not having a community, not having someone to talk with, not having someone to support me through seeing my portfolio lose 30%, 40%, even 50% of its value was very, very painful. Luckily, I discovered about myself that I could withstand those big paper losses. Even, and I think I've written in one of my emails about this story, at the beginning of 2009, when the market was near bottom, I took a loan and I invested in a very cheap stock that I found, and it turned out very, very well to invest in that time period, because this was basically money on the floor, but it was very, very hard to do. Very, very hard to do mentally. So mental support is one of the biggest struggles that individual investors do. Now, I consider myself lucky because I found Yoav. And since we found each other, we support each other for good times and bad times, because we know that in the long term, everything will turn out okay, and value and momentum will shine. And it shines. It's doing very well in the long term, but during the short term, we sometimes see markets decline and our portfolios decline, let's say on a month-to-month basis. And then I find it very helpful to call Yoav and discuss with him. And he tells me, we're long-term investors, okay? This has happened in the past. We have to keep being invested and everything will go back to normal. And you know, this encouragement from Yoav, and I think that I'm doing the same for him when he needs some help, is very helpful. So mental support between investors is very, very helpful and meaningful. And this is one of the main reasons that I created the website. So if you look at what is taldavidson.com, it's two things. One, it's the algorithm, the screeners that save you a lot of time. And secondly, it's the mental support. It's having the community, being able to go on the forum and ask questions and get support and have someone to discuss with, to communicate with, and weather through harder times and better times in the market. And I think maybe a third thing, which is a bonus, is the education. When you go on taldavidson.com on the premium service, you learn. I've spent a significant amount of effort and time on building a full-length online video course that you can see if you become a premium member. And I go through the theoretical aspects of quantitative investing and also on the practical aspects, meaning I provide step-by-step guidelines for people who want to start quantitative models. Now, the benefits of the website, just to finish this long introductions before we discuss some stocks, is that you never run out of investment ideas. So I see three benefits of joining taldavidson.com. One, you never run out of investment ideas. Two, you save a lot of time. And three, you have the support of me and the community to help you with your investments. So let's elaborate a little bit on those aspects. You know, having those strategy screeners, the deep value screener, the quantitative value, the quantitative momentum, the net nets, the negative EV, the Graham's defensive investor, and maybe in the future I will add more. It gives you tons of investment ideas. You don't have to spend time. It's right there. You want the cheapest stocks in the universe, it's right there. You can filter it according to market cap. You can filter it according to valuation, according to return on capital. There's various parameters that I provide in my screeners that you can filter those results. But the heavy lifting is done by the algorithms that create this initial list. And the algorithms, I can tell you, and I received this feedback, and this is a very encouraging feedback. there's a lot of nuances. You have to know well what you're doing, to read research and to do backtesting really, really diligently, which is what I've done. I mean, for every strategy screener that I have on the website, I read about 30 academic papers really, really carefully to learn the insights and make sure that I don't just put stuff out there, that everything has been researched, that I'm not the only one who's using those rules. And some of the strategy screeners, especially the quantitative value and quantitative momentum ones, are based on cutting edge research, really research that was published in 2017. Even last year. This is really cutting edge research that I utilize in the algorithms that provide this initial list of stocks that you can later further filter. One, you never run out of investment ideas. Secondly, you save time. So you can decide to use the website just for finding compelling investment ideas. I mean, as a starting point to doing your own research, and it will save you a lot of time of reading many, many articles, because the compelling stocks are right out there as an output of the screeners. And you can save additional amount of time if you decide to build a quantitative portfolio, meaning take the outputs of the screeners as is and build a well-diversified portfolio out of those. And this is what I do in my personal account. Basically, I take the outputs of the algorithms, I take the stocks that I find in the screeners, I buy them indiscriminately, I mean without further judgment, and then I hold them for a certain amount of time, 6 months for momentum, 1 year for value stocks. And research shows, and also, you know, the gurus are Wesley Gray and Tobias Carlyle and AQR, I mean Cliff Asness and all those guys. All the research shows that if you buy those quantitative stocks indiscriminately, you do better in the long term than if you apply judgment and you just buy a handful of them after you do research, because we are human, we are biased. Sometimes we see stocks with risks or problems and we do not buy them. We just don't want to hold this junk. And this is a mistake, because stocks that have problems, they usually are valued very attractively. They are usually cheap. And you should buy them. You should own them, really. You should own junk, because junk stocks are cheap stocks. And when they revert to the mean, when they come back to normality, so they appreciate in price much better than the entire market. And chances are that bad stocks will become normal again, will revert to the mean. This is the professional term. And if you watch my videos, if you watch the online course, I talk about that time and time again. It's a very important concept, reversion to the mean. So if you decide to build a quantitative portfolio, you will save a lot of time, because basically you will have to touch your portfolio, maintain your portfolio only once every 6 months or once every year, and that's it. And so you will spend less time, you will earn more. I mean, that's a win-win situation. And the third benefit is having the support of me and the community. We already touched on that. The forum is available to premium members. They can go and ask questions about things they have read, things that they didn't understood, stuff on the online course, stocks that I have on the portfolio, anything but specific personal advice. I cannot give specific personal advice because I'm not allowed to. So according to the Israeli law, I'm allowed to educate, to provide research on this website, but not provide personalized advice, because that's something that only registered investment advisors registered money managers can do. So everything else is allowed in the forum. Go ahead and use it. So going on the website is like having me, let's say a quant, work for you for $35 a month. So it's like you're employing me for $35 a month to do you a lot of work, to design quant models just for you. And I think that's a great deal. I mean, if I would have charged $100 on that service, it would still be attractive, because basically it's like employing a quantitative analyst and getting their results for just $35 a month. I think it's a great deal. I didn't want to charge more than that. I may do in the future, but I wanted to be accessible and as many individual investors to utilize this service. And also I would like to grow our community. So that's why I believe that I priced the service attractively and hope that as many of you who are considering to join will do so. What I want to do now is I want to do some Q&A. So I received some questions over emails. Unfortunately, I cannot see or discuss with you your question. If you have access to the chat box, so you can go ahead and ask me question in the chat box. In the meanwhile, I will try to answer some questions that I received over email. So one person asked me, with the market at all-time highs, is it the right time to invest? That's a very tricky question. So there's no definite answer for that, and it depends on yourself. But I can tell you what I'm doing. I'm fully invested. Even today, I'm fully invested. And I believe that you cannot time the market. You cannot know if the market will go another 100% up from here, or we're at the beginning of a decline. It may be that the market will continue being range bound during the next few years. And in this case, value stocks and momentum stocks will do better, will do well, and that's what I'm investing in. So I'm saying there's no way to know what the market will do, what the future will hold. Then you have to get to a decision. And my decision was to be 100% invested. And there's a Forbes article, a nice Forbes article that showed that value investing has been lagging growth investing since the latest market cycle started in the beginning of 2009. So growth has done better. And that's why I think that investing in value stocks now is an excellent decision to make. I think that history shows that value beats growth in the long term. And after a few years where growth has beaten market lately, now is a very good time to invest in value stocks, because eventually, and hopefully very soon, they will outperform growth stocks. And I think that I also share my thought about the division between value stocks and growth stocks. I think it's an outdated division. I think you shouldn't look at value stocks versus growth stocks, especially as this division is based on price to book, which is kind of simplistic. I think that you should look at value stocks and momentum stocks. These are the two opposites. Okay, value stocks are underpriced because the general public overestimates bad news, and momentum stocks are underpriced because the general public underestimates good news. So that are the opposites, and the two opposites that you want to hold. And one of my model portfolios, the Lion portfolio, which premium members can access in the website, is all about combining value and momentum stocks into a single portfolio. So you enjoy the diversification of value and momentum. And this is what I invest in my personal fund, with my personal money. It has done very well, both since I started the model portfolio in May, and also very well in my personal account, and very well historically. If you look at the data, and I provide the data in the website. So I decided, everyone will make its own decision, but I decided to be fully invested at this time. I know about myself that I can weather black swan events like 2009. I can weather those and be fully invested. And if it happens again, then I will still be fully invested. But I think that the chances of having another black swan just a decade after the previous one are rather low. And I think that the US economy is in a good state. And I don't expect stocks to crash. And if they crash, I want to hold value stocks. I want to hold momentum stocks. And that's it. Now, one of our subscribers, Alberto from Spain, he experimented a little bit with some signals, risk-on, risk-off signals, which advise an investors quantitatively on when to exit the market. Those are interesting concepts that may be good for some people. You know, they don't make you earn more, but they reduce the volatility of portfolios. So I'm thinking of maybe adding that to the service. So if you join the service, you will be surprised to see that it's not stale. New stuff is coming up as I learn, as the community discovers new things, and new stuff is coming to the service. The second question that I got over email, so I'm looking at it now. Somebody asked, what is the best way to use screeners on the website? Now, I think that I answered this question. I said, one, you can use it for idea generation. I mean, just as a starting point to do your own research on stocks, and it will save you time finding this initial list. And this time is well worth the money, I believe. I would have gladly paid much more than what I'm charging to save time. I mean, an hour of my time is worth much, much, much more than $35. And throughout a month, I'm saving a lot of time. And the second way is building a quant portfolio. Now, many people are not feel comfortable of building a quant portfolio right from the start. So what I suggest to people, and this is how I started with quantitative investing, is allocate a certain amount of your funds to quantitative investing. So even if you want to invest in, let's say, 20 quant stocks, I mean, 20 is the absolute minimum. You shouldn't buy quantitative stocks if you're buying less than 20 stocks, because with quantitative investing, you have to diversify. And go on my online course if you're a premium member, and because I talk about it, you have to diversify. So if you decide to buy just 20 stocks, you can go as low as $20,000. I mean, I use Interactive Brokers as my broker. It charges me $1 per transaction. And I think if I invest just $1,000 in a holding, in a stock, and buy 20 stocks for a total of $20,000, that's good enough. So you can experiment with as low as $20,000. And if you don't have this sum of money and you still want to learn, you still want to experiment, you can open a paper account, a virtual account. Like I use Morningstar.com. You can use, there are many services that you can use to start a virtual account and start understanding, getting the feel of having a quant portfolio. What I saw over time is that I gained confidence in those quantitative portfolio. I saw that they don't crash. Okay, they may be volatile. There's times where they're volatile. Most of the time, they're not volatile more than the market. And then my confidence grew with investing quantitatively, and little by little, I enlarged the portion that I allocated to quantitative investing. And eventually, I became 100% quantitative, or almost 100%. And this is what I suggest to you. You can use the website to learn, start a virtual paper portfolio, allocate some of your funds to quantitative, gain confidence, and then enlarge this quantitative section, or just use the website for idea generation, which will save you time and save you money and give you confidence with your investing. The third question that I got from subscribers is, what new content should subscribers expect to see every month? I guess that the investor that asked me this question, he wants to understand what do he or she gets by paying $35 a month. I mean, what is the value of that? What do I provide on a month-to-month basis? So let me answer that. So first, you get full access to all the screeners. That's trivial. That's the core content of the website. And I update those screeners, the fundamental data of the screeners, weekly. The prices and the valuation is naturally updated in real time with 20 minutes delay. And the fundamental data, I fetch it from my data sources. I fetch it weekly. So this is the main content of the website. The spreadsheets, the screeners are always fresh, and you can access them anytime. They do the heavy lifting. Now, on the forum, I go on the forum every day. I try to answer every day. Sometimes it takes a couple of days, several days for me to answer questions. But the forum is a great place to ask questions and learn and ask for support and share your experiences with other investors. So that's another aspect that is not on a monthly basis. It's real time. It's always. The forum is always available, and you can use the forums every day. Every month, I create a monthly PDF newsletter. Now, this is a newsletter, a long newsletter, which is tens of pages long. And I include a lot of exclusive content on this newsletter. So I have there a commentary piece and also a review of the latest research and books and articles, because I want to help you be educated with quantitative investing. So I read a lot of stuff, and then I write about what this stuff means and how you can utilize it to become better investors. I also have a spotlight on a methodology piece or an investing theory piece. So you can learn more every month with the newsletter. And also, we have the sections that go over the model portfolios performance, how they performed during the last month and since inception, and changes that we've been making to the model portfolios, if we have. And also, I write about compelling stocks that the algorithms output to help you with your research and save you time. That's my intent with the monthly newsletter: to educate, to entertain, and to save you time. In addition to that, once the forum picks up, I will send every couple of weeks an email with member news, with a curation of important forum discussions. so that you won't miss any important stuff that went on the forum if you don't have the time to monitor it on a daily basis. And occasionally, I will add educational materials, videos, live calls. We have to see how that goes. I mean, currently, I'm feeling that this live call is going well, although we have this technical problem and I cannot converse with you, but I'm feeling good about talking live. So we may do that if the feedback is positive. If not, we'll find something else to benefit you as subscribers. So that's what we do on a month-to-month basis. And I think that the idea is to save time, to help you gain confidence and support you, and also to educate and entertain. Finally, we have a short time to the end of this call. I want to go over some compelling stocks ideas. And here I'll share my screen and I'll walk you through how I'm thinking about compelling stocks today. Great, so here I'm sharing my screen. And I'm going on the website on taldavidson.com, and I'm starting from the deep value page that you can either find on the dashboard or go to the screeners and go to deep value. Now, deep value, I mean the cheapest stocks in a universe. And there are actually two screeners here. One is based on EV to EBIT, and the other one is based on VC2, which is a value composite, meaning a composite of several valuation ranks. And let's start with the EV to EBIT. There's a very famous investor, Tobias Carlyle, who has registered a name for EV to EBIT valuation rank. He calls it the acquirer's multiple, but it's his registered trademark. So that's why I'm using just EV to EBIT here and not calling it acquirer's multiple. Tobias has rights to that term. So let's see what's compelling stocks I want to highlight here. So first of all, you see that Finjan Holding, it's the cheapest stocks in the universe. Like its EV to EBIT is 1. It's really, really cheap. It's the cheapest stock that I have, but its market cap is fairly low, just $120 million. By the way, its EV to EBIT is really low. And this company has several problems, risk issues, but it's very, very cheap. Now here I would like to highlight several stocks like Bed Bath & Beyond. Who doesn't know Bed Bath & Beyond? Who's never been in Bed Bath & Beyond? I mean, it's only available in US, and in my trips to the US, I don't live in the US, I live in Israel, but in my business trips to the US, I've visited Bed Bath & Beyond. It's a business, it's a real business, it's a real store. Of course, all retailers are struggling, they're suffering. And Bed Bath & Beyond has their share of struggles. I mean, investors are fearful that Amazon will eat its lunch, will drive it to bankruptcy, but it's still a business. And I believe that Bed Bath & Beyond will not go away. People will continue buy furniture and textile in real store when they can feel it. Not everyone is doing window shopping. There's enough customers to keep Bed Bath & Beyond alive, and today is trading very cheaply. I mean, only about 2 billion market cap, which is like a fourth of what it traded just several years ago. It was at 80, now it's back at 90. Let's look at the valuation. The valuation here is like 3.2 EV to EBITDA for a big company, much smaller than it was, but for a big company that is selling and has a return of capital of 37%, 5 years return of capital average of 35%. I mean, that's a very cheap price to pay for a stock. So that's one I wanted to highlight. The other one I wanted to highlight is FCAU, Fiat Chrysler Automobiles. Very, very cheap stock, like EV to EBITDA of 2.3, EV to EBIT of 4.5. This is a big company that makes car. I think it has a good return on capital. So I think it's 19. Is it that line? Yes, it's 19%, 5 years average return on capital. FS score of 8. Now, FS score is important metric of quality. The higher, the better. I write about it. And I'm about to publish an article about the FS score, so tune in. Anyway, this is a very high quality company, Fiat Chrysler, and some prominent investors are investing in it with significant amounts. And I'm talking about Monish Pabrai, about Guy Spier, and about other guru investors that see the value in Fiat Chrysler automobiles, albeit the many problems. Okay, now every cheap stock has a lot of risk, a lot of problems, and this is too short of a call to go into all of them. Let's go quickly to the value composite valuation screener. Now, what is value composite? Value composite is basically a formula that takes into account the average of several valuation metrics. So it's not just cheapness based on EV to EBIT, it's cheapness based on a formula that takes into account EV to EBIT, price to earnings, price to book, price to sales, price to free cash flow, and mixes everything up. And the cheapest stocks, you find them on the top. So here you see that Bed Bath & Beyond is like the cheapest one according to Value Composite rank today. And then Fiat Chrysler. We have some retailers here that are struggling these days because of the Amazon fear, like Hibbett Sports, it's a retailer. Chico is a retailer for kids. Macy's, naturally, Dick's Sporting Goods. So the 15 highest ranking job stocks have quite a few of retailers, but then there's ArcelorMittal, which is a steel company. And we're hearing the news about tariffs, about Trump, and what he's doing to steel tariffs. So that's why ArcelorMittal is struggling. And we have some high-tech companies like Lannett and Net1 in this chart, but all of those are cheap. Now, Value Composite 2 is something you can read about in the book What Works in Wall Street by Jim O'Shaughnessy. It's a concept that was researched elaborately, extensively, for tens of years, backtest going to, I think, the 20s. And Jim O'Shaughnessy has done a remarkable job proving that Value Composite is a great metric to choose stocks with. Now, there's a nuance, because you cannot just pick one stock and say, hey, I found a really cheap stocks and not research it further. If you want to pick just one stock, you have to do the research, like Monish Pabrai has done, like Guy Spier has done when they decided to invest a big portion of their funds in Fiat Chrysler. But if you're like me or us, quantitative investors, you would invest in everything, in all of these, because you want a diversified bucket of opportunities. You don't know which will work well, but as a group, the group will work well. So that's some compelling deep value stocks. Let's see some others. Now let's go to quantitative value, one of my most favorite screeners. Quantitative value, what it means is the highest quality stocks out of the cheapest stocks. So you should read about it, but basically it says take the, I don't know, the 25% or the 20% or the 10% cheapest stocks in a universe. I'm using the 25%, so the quarter of the stocks that are the cheapest in the universe, and then rank them by quality, and buy the highest quality stocks. So you get both cheapness and high quality, but it's nuanced. It's not done like the magic formula. It's done better because cheapness get a higher significance than quality. You first filter for the cheap stocks, and then you pick the highest qualities out of those cheap stocks. So here I have several good examples for good stocks. Like the first one is Dorchester Minerals. So it's a commodity company, but it's both cheap, it's very, very high quality, and I think it's worth a consideration. Also, there's the retailer, Dollar General, which compared to the other retailers that I showed in the deep value screener, this one has high quality. So the quality shows up at the quality rank, which is very high here. And I can show you some aspects of that. So the return on capital is 24%, average for 5 years. The debt to equity is rather low. The current ratio is high. And the F score, which is an indication of quality, is rather high. And this stock is cheap enough. It's high quality, cheap enough, so it's one of the stocks that I think are compelling today. We also have a Coca-Cola here, which is also a compelling stock with a good return on capital, with high F score, with a rather cheap price, and very high quality. And one other one that I want to highlight is China Mobile. Now, I've written on China Mobile in Seeking Alpha, and that's a good place to, that's a good time to remind that I also write in Seeking Alpha. So if you go on my profile in Seeking Alpha, you could find an article about China Mobile, which I think is one of the highest quality, cheap stocks that are attractive today in the market. And I'm working with Seeking Alpha today to sort out the legal stuff, because I want to make those articles, which are exclusive to Seeking Alpha subscribers, I want to make them available to Tal Davidson subscribers, premium subscribers as well. So I need to work out the legal details to do that. So that's China Mobile. And before we end, I want to go to the Graham's defensive investor strategy screener page, and show you what the screener provides today. So many of the stocks that you see today in the Graham screener are utilities, like Consolidated Edison, like Next Era. PPL is also a utility. And we have here, so utilities are, and if I'm not mistaken, also Pinnacle West Capital is utility, but I'm not sure. Utilities should not be avoided. I mean, many people avoid them because they don't consider them worthy stocks, but they should not be avoided. Benjamin Graham had invested in utilities. They are rather safe stocks. Okay, they don't appreciate greatly, but they're also not volatile. Their beta is very low. They give a dividend. They are regulated, but they're a good investment. And I think they are worthy of holding these days when there are trends of raising interest rates. So utilities are trading at compelling valuations. And that's the case also for telcos and REITs. So I have here Kimco Realty, which is a REIT, and I have some telcos, and I assume that all of them trade at compelling valuations, partly due to the risk of the concern that higher interest rates are going to impair the business results. But if you look at the data, at the history, you see that in times when interest rates was rising, REITs actually did well. And I can almost, I can almost bet that also utilities did well and telcos did well, because it's the same mechanism. I haven't checked it. I checked only the case for REITs. So companies, such dividend-paying companies like telcos and not telcos, like utilities and REITs, they appreciate when interest rates rise, according to common belief. So in general, those picks, those stocks in the Graham's portfolio are more conservative, but that's the idea of being a defensive investor. Okay, that's the idea of being defensive. You're not chasing after the best returns, but you want adequate returns and low risk. So I must tell you, in my personal account, I have quantitative value, I have quantitative momentum, I have Graham's defensive investors stocks, and I have several deep value stocks. So that's what I do, and I think there's a place for Graham's defensive investor ideas in your portfolio as well. So let's go back to the video. Great. And I think this is how we conclude our live call. Thank you for being with me. Thank you for watching. I am sorry that this was not a conversation, but I resolved the technical difficulties that we had, and we will have a live conversation going forward. I hope that this was enjoyable for you and educating. I enjoyed it very much. And also, if you're considering joining a premium membership on taldavidson.com and you have questions or anything, just send me an email. You'll see that I answer every email I get. And I'm looking forward to hearing back from you. So happy investing, and have a good day or a good night. Cheers and bye-bye.